Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Putin pushes back. Russia's president rejects Donald Trump's 30-day ceasefire, but agrees to pause attacks on Ukraine's energy infrastructure. This as the German parliament passes a landmark package to boost defence spending. No surprises, the Bank of Japan holds rates steady. We're going to hear from Governor Ueda later this hour. Up next, it is the Fed and its forecasts, with some expecting a stagflation scenario for the US economy. Plus, a raft of new innovations from Nvidia fails to revive the chip maker's share price. We discuss if CEO Jensen Huang has lost the Midas touch. Good morning, happy Wednesday. A bit of a holding pattern across European futures after 3 straight days of gains. We'll see if that picture continues. Just a very modest upside being flagged by the Stoxx 50 futures, currently up just 2 points so far as we build up to the open. With that focus, of course, on the decision, but arguably more importantly, the dot plots and the forecast from Jay Powell of the Federal Reserve later today. FTSE 100 futures here in the UK looking to add just 12 points. S&P futures stateside after further losses yesterday and continued flows out of US equities, adding just 0.1% as we again build up to a Fed day and whether or not the Fed put is going to be at play to reassure investors. Nasdaq 100 futures after losses of 1.7% yesterday by the end of the close looking to add just 29 points. Let's flip the board and have a look cross asset. Relative stability across the Treasury curve so far in the session. 429 right now on the benchmark 10-year. The Japanese yen a little softer by 0.4%. The BOJ standing pat. We wait, of course, to hear from the governor in about 30 minutes' time as they raise the risk in terms of the focus on geopolitical risks, external risks, as inflation, of course, continues to be relatively supportive to their mandate. Gold above that record $3,000 per troy ounce level, gaining again today in the session at 0.3% higher. And Brent, $70 a barrel, a little softer in today's session, down 0.5% as the focus switches from the geopolitics in the Middle East, at least for now, to oversupply constraints. Talking of geopolitics, Russian President Vladimir Putin has rejected Donald Trump's call for a 30-day ceasefire in Ukraine. During his call with the US President, Putin only agreed to limit attacks on energy infrastructure while demanding a stop to the flow of weapons and intelligence to Ukraine. Meanwhile, Ukrainian President Volodymyr Zelensky says he'd like to speak to Trump about the details of Moscow's proposal.
We
will support any proposals that lead to a sustainable, just peace. But for this, we must understand what is at stake. What are the details? And I hope to God that we know all these details so that the partners talk to us, because there are 2 sides in this war, Russia and Ukraine. Trying to negotiate without Ukraine, in my view, will not be productive.
For more, let's bring in Bloomberg's Russia economy and government editor, Greg Sullivan. Greg, what more do we know then about the sticking points? How much, in terms of the accounts that we've heard from the phone call, they've differed in terms of what we heard from the Kremlin and what we've heard from the White House? Trump is talking up this conversation and these apparent commitments from Vladimir Putin, but some are taking a very different take, which is this is a Russian government and a Russian leader that is nowhere close to agreeing to a ceasefire that has been articulated by this Trump administration.
I think that's a very accurate read. What we know about Putin is that he's likely to try to drag out this process. He has very little incentive at the moment to agree to a ceasefire, aside from pleasing Trump. But on the battlefield, he is making slow, albeit costly gains. His forces have almost completely dislodged Ukraine from the Kursk region. And he's really making a litany of demands that are very hard for Kyiv to swallow. The first one is that he does not want Western weapons supplied to Kyiv during the duration of any ceasefire. Now, European allies have largely said that this is not a non-starter. They see Ukraine being able to defend themselves as the best bulwark against a future resumption of hostilities. And they also see it as a play for Russia to basically continue to rearm while keeping weapons out of Ukraine during a ceasefire. So that is one of the demands that it's very harsh. For a longer-term settlement, there are also demands such as never joining NATO, which Ukraine has said it was key to their security guarantees. So these harsh demands are definitely from a maximalist position to try to play for time and drag out the process.
OK, so the demands are there still for Putin and his team. And one would have to wonder whether or not Ukraine is being viewed by the Trump administration as something of an obstacle towards much bigger ambitions from the Trump administration, arguably looking to reset ties with Moscow, but also arguably, it seems, to try and cleave China and Russia apart. Let's take a listen to what the president has been saying.
The first thing you learn is you don't want Russia and China to get together. It was always a natural enemy situation. They're probably friendly now, but we're going to be friendly with both. I think we're going to be friendly with both. China needs us in terms of trade very badly.
So, Greg, President Trump saying he wants good relations with both Russia and China, and talking about that close relationship, as he describes it, for now at least, between Beijing and Moscow. He doesn't see that as being necessarily a long-term proposition. What do we expect to see, maybe, from this Trump administration to build out ties with both Moscow and Beijing going forward?
I think those were very significant comments from President Trump last night. And I think they also shed some light in the motivation. Up until now, we've seen a much more conciliatory approach towards Moscow than we've seen, say, towards Kyiv. And if he is truly trying to split the Beijing-Moscow relationship, that might go some way towards explaining it. Beijing has been hugely important for Moscow. China has been an economic and diplomatic lifeline since Russia was hit with a slew of international sanctions in the wake of the invasion. So it's hard to see that anything immediate will break that relationship up. They've declared a no-limits partnership, but Trump has vowed to be friendly to both countries. Nonetheless, he's very fixated on this trade deficit with China and certain energy policies that he believes have created an unfair relationship between the two. So that would likely need to be addressed before any friendly outreach towards China.
OK, Bloomberg's Russia economy and government editor Greg Sullivan with that important update and the context. Greg, thank you. Let's cross over right now to Singapore, where Avril Hong is standing by with a check on the Asian markets. A bit of a soggy session, a bit of a mixed picture, Avril.
Oh, absolutely. And we're actually seeing how Chinese tech shares rally has taken a breather, a step back. And this is despite Xiaomi. Remember that bit earnings that we were watching out for, that sales beat. The rest of the Chinese tech complex is actually treading water. We had the likes of Bank of America citing potentially a meaningful correction soon, which I'll talk more about in just a bit. But keep an eye on the Japanese stocks as well as they look ahead to Ueda presser. We are seeing the banks underperforming while the Japanese trading houses are still doing well. Let's flip the board and take a look at dollar yen, because as you know, the past couple of sessions it has been climbing, and this is despite the build-up of net long yen positions. And if Ueda sounds a bit more dovish than expected, they could be vulnerable, the currency, to pull back. And of course, we are also going to be keeping a close watch on his potential comments on the bond market. As you know, he recently sounded quite unbothered about the rise in yields, but it does sound quite unrealistic to expect him to sound hawkish given these global tariff risks along with domestic political concerns. Now, I'll flip the board and take a look at this chart courtesy of Valerie Titel that will show you as well that parallel with the 2015 boom and bust cycle for Chinese stocks. That is what BofA is actually flagging, and they say, you know, this mid-January run up of about 30%, where we've seen the Hang Seng China as well as the MSCI China, is, you know, reflective of the moves back then. They also cite a recent trip to Shanghai where investors sounded quite worried, especially the long-only investors, of the lack of improvement in the job market, the economy, and then there were some that also flagged a bubble emerging in the tech space. So that's among the concerns that they are raising for Chinese tech stocks.
Yeah, shadows of 2015 will make some palms sweat, certainly in Shanghai, Shenzhen and Beijing, you would have thought. Avra Hong in Singapore with a check on the Asian markets. Thank you. Traders, of course, seeking clarity from the Fed as well. So we've got that clarity at least partly from the BOJ, and we'll get that press conference at 6:30, of course, from the governor. And then we look ahead to the Fed later today. Recession fears, of course, still being discussed in the States, and uncertainty certainly in focus over Trump's economic policies. Let's bring in Bloomberg's Valerie Teitel on how the markets are positioning ahead of the Fed meeting and whether or not Valerie, we're going to be getting a Fed put. Is that something we should be bracing for from Jay Powell?
Look, Tom, I think tonight's decision is going to be very interesting. I want to take you through a hawkish scenario and a dovish scenario that we could possibly get from Jay Powell later this evening. Let's start with the dovish scenario, is that he is out of the gates focusing on the deterioration in consumer confidence, focusing on what you mentioned, those rising risks of a recession that economists have pointed out recently. He also emphasized the downside risk to growth from tariffs. Instead of talking about inflation, he's more focused on the downside risk to growth that this tariff and tariff uncertainty could entail. Lastly, again, maybe a bit of a Fed put. He acknowledging the recent decline in equity markets, maybe calling that concerning. On the flip side, though, Tom, we could get a hawkish Fed, and I think we're going to know this right out of the gates when they release their dot plot. Let's say they only imply one cut for the 2025. That would take the market by surprise, and he would focus instead on the recent rise of inflation expectations, in saying that the Fed is in no hurry, that monetary policy is well positioned where it is, and they need to stay the course. He could also talk about the U.S. economy as solid. He has characterized it previously as being solid and in a good place. Does he repeat those lines when talking about the U.S. economy? I think a hawkish surprise would jolt the markets a bit more, and that is because if we look at how the market is positioned versus those dots, if you flip on, I can just talk about this one thing. The market is currently implying over 2 cuts for the Federal Reserve through this year. If he doesn't change the dot plot and does imply 2 ahead, that could surprise the market in a hawkish direction.
OK, those two scenarios then, the dovish and the hawkish, and we'll get the details and the answer later today with all that live coverage, of course, and analysis. Valerie Teitel from our markets team, thank you. Here's what else we'll be thinking about today. Then 12 p.m, we are going to be getting the EU defence white paper, so some more details in terms of how Europe is looking to step up its defence spending after, of course, a pivotal day for Germany, pushing through the Parliament, of course, the Bundestag, the plans for additional spending. Then it moves on Friday to the Bundesrat and then is expected to be signed off by the German president. But still, additional processes to go through. The white paper out later today. We'll bring you the details. 1 p.m. Of course, UK time, we're going to be hearing from the ECB's Villeroy as well, so another voice in terms of how the ECB is thinking about the next steps as it becomes arguably a more challenging scenario for the European Central Bank. And at 6 p.m, it is the big one, the Fed decision, and, of course, the press conference from Jay Powell, which we will bring you to live, of course, with all the context. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. Talking of Germany and defence spending coming up, German lawmakers have passed a landmark spending package designed to unlock cash for defence and infrastructure spending. We will get the details and what the next steps are then for this German economy and its rearmament programme. That's coming up. This is Bloomberg.
March 26th, UK Chancellor Rachel Reeves delivers the government's spring statement. How will she fix the hole in the UK's finances after her fiscal headroom was all but wiped out? And will she be able to keep her own fiscal rules? Live from Westminster, Bloomberg Television has special coverage, starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. To Germany now, where lawmakers have passed a landmark spending package that will unlock hundreds of billions of euros in debt financing and defence and infrastructure in terms of the funding. Let's dive deeper then into this with Bloomberg's Oliver Crook in Brussels. Ollie, German lawmakers then going from words to action, pushing through this vote. What are the next steps? How significant is this?
Tom, this is a complete bombshell for the sort of European economy and for the sort of Germans more broadly in this sort of paradigm shift. I mean, we've been talking about it for a couple of weeks, and it's gone, as you say, from theory into reality. We have a conservative German government, the CDU, the party that brought in the debt brake in 2009, that has basically scrapped it and ushered in a new era of just absolutely mammoth spending. I mean, we're talking about the scale potentially of spending here. Remember, there's a 500 billion euro infrastructure fund. Then there's unlimited. There's no cap on what they can spend on defense, and they've also really widened what the definition of defense and security means to mean a lot of different things. So we're talking potentially to the order of €1 trillion over the next sort of decade or so of spending from this German government. That dwarfs, the spending that was done in the Marshall Plan, that dwarfs the spending that we saw in after reunification in Germany in the 1990s. And when you look at the impact that this has had in the market in terms of sort of euphoria, yes, we've seen it in the bond market, we've seen it in the equity market, but I was just speaking with the head of KKR's infrastructure investment, who happened to be in Berlin yesterday, saying that basically a lot of the deals that they're now cutting, it's not in the United States, a lot of them are starting to come into Europe, and that there's a real euphoria that this is going to sort of unlock something significant in Europe. And we look at the sort of what the economists are saying in terms of what it could mean for growth. We're talking potentially adding 2 percentage points to growth in Germany on average a year over the next decade. It'll also have some trickle-down effect to the rest of the European economy because, of course, the Germans can't build all of the infrastructure on their own. They're going to need more capacity. Could also be inflationary. But really, Tom, this is really a paradigm shift. And in terms of the timeline, it got through the Bundestag yesterday. It will go to the Bundesrat, the upper house, on Friday. And this could be signed into law by the president of Germany by Friday.
So that's the time frame. Ollie, you're sitting there in Brussels, of course, keeping your finger on the pulse of what the European Commission is thinking in terms of the response. We're getting the white paper later today. To what extent is Germany's efforts a catalyst for the rest of Europe?
Well, I think that, unfortunately, it's going to dwarf potentially what the rest of Europe can do, right? The EU Commission is trying to come up with a lot of different proposals. Many of them, though, lack kind of new money, right? There's a 150 billion euro loan. That was one of the things that the Ursula von der Leyen announced a couple of weeks ago. There's about sort of making fiscal headroom in order to allow borrowing from a national level under the EU's rules. But as we've talked about a lot, Tom, the limiting factor for many of these countries is not the fact that there are EU rules. They break the EU rules all the time. It's the fact that the bond market, basically, interest rates are too high and they have way too much debt. But listen, we heard from Ursula von der Leyen yesterday. They gave us a little sort of feeling of what we're going to hear from the EU Commission a little bit later. Have a listen to what she had to say in Denmark.
Europe is ready to step up. We are ready to take control of the change that is inevitable. Because we cannot afford to be pushed around by history. And that means acting now is a must. Acting big is a conditio sine qua non for speed, scale and strength by 2030.
And we should just say that she's speaking there in Denmark. Denmark's policy on defense has been, their stated policy on defense has been buy, buy, buy. That is, again, as we're saying, not something that can be replicated across the Eurozone and across the EU. This is a sort of bloc where there's a lot more sort of fiscal strain on many of these countries that are making very difficult political decisions about where money needs to be spent into the future. You think also about what Ursula von der Leyen is watching. She's sitting at the sideline like every other European leader while Donald Trump is on the phone with Vladimir Putin, where there's a White House readout where the sort of the Ukraine war, is not necessarily a footnote in the conversation, but is not seeming to be the main part of the conversation. So this, again, and the other thing that's brought bear, they don't want to be sort of passengers in this sort of story of history. What the Europeans have learned that basically in this Trump era, if you don't have a military, you don't have a voice, and if you don't have a voice, you have no influence over the sort of course of affairs in a Trump sort of a dominated world.
OK, Bloomberg's Oliver Crook in Brussels for us, of course, and we look ahead to that EU white paper as well as Germany steps up its defence spending, or at least its policy around that, and we get more clarity if that gets cleared in the Bundesrat on Friday, as Ollie was saying. Coming up, switching focus to technology, Jensen Huang. Has he lost the Midas touch? He's still got that black leather jacket and looking slick on stage. but it's a very different reaction across stocks that he mentions as he delivers more details, of course. Nvidia shares ticking lower yesterday despite that flurry of new product announcements. We get the details on what exactly was revealed and what it tells us more broadly about the sentiment around the maker of those AI accelerators. That's next. This is Bloomberg.
Today, the Fed decides.
People just want clarity. Business leaders want clarity. Investors want clarity.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
What do they need to see to have confidence in the forward trajectory?
Could our big surprise be a growth slowdown?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Welcome back to Bloomberg Daybreak Europe. To technology now, and Nvidia. New product announcements, of course, by Nvidia, but failing to boost the tech giant's share price, which is already down 20% from its January peak. At its annual developer conference, CEO Jensen Huang unveiled more powerful chips and a platform to develop humanoid robots. He also announced a partnership with General Motors to develop AI cars.
Time for autonomous vehicles has arrived. And we're looking forward to building with GM AI in all three areas. AI for manufacturing, so they can revolutionize the way they manufacture. AI for enterprise, so they can revolutionize the way they work, design cars and simulate cars. And then also AI for in the car.
Our Asia tech reporter Annabelle Drulas joins us now with some of the details. Annabelle, what kind of stood out to you? Is it a 2-hour speech by Jensen Huang at this event, walking through a number of different prospects and announcements? We know the stock ended lower by about 3% by the end of the day. What kind of jumped out to you in terms of what he revealed?
Yeah, that's right. I mean, as you said, it was a pretty lengthy address, and it's been interesting also to watch the evolution of GTC, because a couple of years ago this was sort of a little-known conference that just attracted developers essentially, and now it's really front and center in AI and exactly what the roadmap looks like. So at this GTC, I mean, we got new AI chips, for instance, technology being announced. Again, it's a really interesting moment for the company, Nvidia as well, because it's been stratospheric growth over the past couple of years, and now there's that really big question mark that we've had for really quite a period now, but whether spending on AI, the rally that we've seen in Nvidia's stock to date, even though it has given up of late, whether that is sustainable. So Jensen Huang, he took to the stage to essentially roll out a new lineup. So that includes a successor to the flagship AI processor that's going to be called Blackwell Ultra. So that will arrive in the second half of 2025. And then additional generations stretching into 2027. He also unveiled some software that's called Dynamo branded. Essentially, it's going to be fine-tuning existing and future equipment. And so the point here is driving further efficiencies and making sort of compute power go for longer or do more for less. And that's really also one of the key questions, because when you've got the likes of DeepSeek, for instance, that essentially are using less compute power, how can Nvidia also help its customers get sort of similar results?
Annabelle, just briefly, what does it tell us about the business roadmap then for Nvidia?
Yeah, well, I guess we got that roadmap of future chips. What's also interesting is how it's going into sort of more emerging technologies. So another announcement that came out of this address was that Nvidia is going to be opening a quantum computing research lab in Boston, and that's going to be really focused on tackling some of the biggest challenges that exist today in quantum computing. There really wasn't probably anything that was such a bombshell for investors, and we did see the stock, as you said, closing down around 3%. The biggest question, of course, for Nvidia moving forward is whether we're going to continue to see that sort of spending on AI, into 2026. And I guess Jensen Huang didn't really say enough to soothe those investor fears.
OK, excellent wrap-up. Thank you. Bloomberg's Asia tech reporter Annabelle Drulas, and what we've been hearing from the CEO of Nvidia. Coming up, as the backlash against ESG run its course, we're going to be speaking to Chuka Umunna of JP Morgan shortly. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. Happy Wednesday. I'm Tom McKenzie in London. These are the stories that set your agenda. Putin pushes back. Russia's president rejects Donald Trump's 30-day ceasefire, but does agree to pause attacks on Ukraine's energy infrastructure. This as the German parliament passes a landmark package to boost defence spending. No surprises, the Bank of Japan holds rates steady. We're going to hear from Governor Ueda later this hour. Up next, the Fed, of course, and its forecasts, with some expecting a stagflation scenario for the US economy. Plus, a raft of new innovations from Nvidia fails to revive the chipmaker's share price. We discuss if CEO Jensen Huang has lost the Midas touch. Checking in on these markets then. 3 straight days of gains for European stocks. A different picture when it comes to the US, with the fund flows out of US equities continuing yesterday. The Nasdaq 100 closing lower by around 1.7%. The S&P 500 taking another knock as well. As we gear up, of course, for the Fed decision late today, fully expected to hold pat, but it's the scrutiny on Jay Powell, his language, of course, around future Trump policy and how they are building that into their scenarios, with the forecast and dot plots as well updated later today. European futures now pointing lower by about 0.1%. We have the defence spending being pushed through by the Bundestag. That moves on to the Bundesrat on Friday. We continue to watch the motions around that, but it seems much clearer now that defence spend input will be coming through from that German economy. FTSE 100 futures currently flat. S&P futures also in something of a holding pattern ahead of the Fed, you would expect. Nasdaq 100 futures pointing up by 22 points. Let's flip the board and have a look across assets. US Treasuries relatively unchanged. The benchmark 10-year yielding you 4.29, just a move of 1 basis point on the yield there. The yen is under pressure, down 0.4%. We await for the lines from the BOJ governor, of course, in the next few minutes, and we'll bring those to you. Gold remaining above that record high of $3,000 per troy ounce for the yellow metal, and Brent down 0.6%. Oversupply concerns offsetting, at least for now, risks around the Middle East. Now, to the defence story and how that is impacting spend on the green economy, renewables and sustainable investments. Europe's recent ramp-up of defence spending and the Trump administration's walkback of climate commitments is putting renewed scrutiny on funding for renewables, and the finance industry's role in the climate transition also in question after criticism by Republicans, including President Trump, of course. Who better then to talk about the transition and the fund flows than Chuka Umunna, Global Head of Sustainable Solutions at JP Morgan Chase, and JP Morgan Chase holding its Clean Tech Stars conference today as well. Chuka, thanks for joining us bright and early in the studio. I want to start with the defence question then. Massive spending being planned by Germany and others within Europe. A European Union that, of course, had been, up until recent years, focused very squarely on that renewable shift. Are fund flows being directed away from renewables? Are you seeing any evidence that the money is going towards defence now and less to clean tech and green tech?
Well, look, first of all, thank you very much for having us on. I think it's probably too early to call that. I mean, obviously, in Germany, the German government's got to get through its plans through the upper house there, past the lower house. But planning the spending is one thing, actually getting the money out of the door is another. And for Europe, it's not just a question of spending more money, it's building up its own defence capabilities, its own defence industrial complex, so to speak, and that's going to take some time. It will not be able to immediately, say, come off US technology and go onto European technology in that respect, because it hasn't yet been developed in some cases. But don't forget that energy security is also seen as a national security issue. So to separate out the need for energy from your defence and national security capabilities is probably not very wise. There is a connection between the two. But at the moment, if you look at where we sit, there is huge and deep pool of capital that is chasing the sustainability and energy transition thematic. Where we're sitting now, at this point in 2025, you've got $3.1 trillion invested in public sustainable AUM. And that is, you know, that's more than at any time since COVID, including the supposed high point of sustainable finance in 2020, 2021. And then if you look specifically at the investment in the energy transition in 2024, there was $2.1 trillion invested in that space, up 11% on 2023. Now, of course, there are regional, you know, variances on those figures. If you look at sustainable AUM, around 85% of that is domiciled here in Europe, more than any other region. If you look at the energy transition investment, that's where you really begin to see interesting variances, because, you know, 40% of that roughly energy transition investment in 2024 was in mainland China, which is more than the US, the UK and the EU altogether. So big amount of capital, lots of investment spending. Of course, it's not enough to enable us to get to those net zero goals that many people talk about. But then, nevertheless, you've got a lot of people chasing that. And that's why we've got over 200 investors coming to the Clean Tech Stars conference that we're holding in London today. So 30% up in registrations compared to last year, which will surprise people.
OK, that's maybe counterintuitive to some people. And you break down how we should look at this not just as a sector. This has different elements within this sector and different regional impacts as well. One region, one nation in focus, of course, is what's happening with the US.
Yes.
A Trump administration that's pulled out again of the Paris Climate Accord. That was expected. They're trying to rewrite parts of the EPA, the Environment Protection Agency, of course, and also trying to unpick some of the Inflation Reduction Act. What is all of that doing, Trump policy, to fund flows into these different areas that you focus on? Well, first of all, as I said, if you look at sustainable AUM, most of it is not in the US. If you look at the energy transition investment, I think the US accounted for around 20% of energy transition. Does it make the US a less desirable investment destination for those types of investments? Well, not necessarily. I'd say two things. First of all, there's some politics around the US Inflation Reduction Act, and more than 60% of the fiscal benefit of the US Inflation Reduction Act went to red states. More than 80% of the job creation coming from the Inflation Reduction Act, red states. So that's why, the House Speaker in the US has said they're likely to take a scalpel but not a sledgehammer to the Inflation Reduction Act legislation. But to be honest, whatever you think about climate change, the one thing where there is consensus is that we need more energy and we need it in abundance. And that's been driven by three things: AI and the power demand that comes with that, electrification, the extra power needed for that, and, of course, what's happening in the emerging markets. As their populations grow and GDP per capita grows, they need more energy too. So we need energy in abundance, in all its forms, and in, fossil fuel-rich countries. They are, therefore, in the short to medium term, going to continue reliance on fossil fuel energies. But those nations where they don't have rich fossil fuel supplies, they're looking at alternatives: wind, solar, hydro, and so forth. And the US is interesting because, for all the narrative around the new administration, they're very keen on carbon-free energies like nuclear, like geothermal. But from an investment point of view, the thing is about all of this, it's got to deliver a return. There are very few, if any, investors who are prepared to sacrifice a decent return, total shareholder return, for sustainability. They are investing in this space because they see it as delivering profitability, adding value. This isn't like altruism or charity, so to speak. Yeah, of course. There is active discussion as well around whether or not to align portfolios with that 1.5 degree target. Where do you think that conversation is, and how significant would that be if that decision to align portfolios with that target, which was seen as something of a red line, is undone? Well, I think people are looking again at the target. Of course, if you come off that target, where do you go to? But, we've learned today the reports from, the new UN report that we hit that, went over 1.5 degrees last year. But I think, in terms of, in the investment bank where I sit in JP Morgan, what are the impediments ultimately to being able to raise capital for particularly green economy companies? And if you look at the private and the public markets, it's been extremely challenging because many of these green economy companies are disproportionately hit by inflation and higher rates and higher borrowing costs because their upfront investment cost is higher. The supply chain issues that we've had have been problematic. There have been public policy gaps as well. And then, of course, for all this new technology, you've got to have the demand. There was all this hype around green hydrogen 12, 18 months ago, but there wasn't sufficient demand for it to be able to take off. And that's where, actually, you talk about some of the public policy changes, that's where they can make a real difference. But look, we are getting deals done in this space. We've done since 2021 $242 billion worth of financing and deals to advance climate solutions for our clients. Just before I let you go, briefly, Chuka, given your previous role as Shadow Business Secretary here in the UK, how would you rate this current government when it comes to the focus on climate change? Well, I think they're doing all the right things. So, what are the common complaints we have from our clients in this space? They can't get a grid connection quickly enough. So cutting the time, which is, 7+ years in the UK to get a grid connection down, that's a good thing to do. Planning and permitting reform, in July last year, removing the moratorium on onshore wind. That was a good thing. Well, look, from the point of view of the UK economy, you're going to need that. But,
the investments that they're making into Great British Energy, that's the right thing to do. The National Wealth Fund seeking to, which is basically a catalytic sovereign fund to get more investment into the green economy. So I think all of the things that we've been arguing for on behalf of our clients that will make a difference to being able to raise capital, they are doing. But look, it's early days. They've still got some time to run in this Parliament. So,
Chuka, thank you very much for your time on a busy day for you and the team. We appreciate it. Of course, the context, the analysis as well, and maybe pushing back against some of those assumptions being made around fund flows into that particular space when it comes to sustainability. Chuka Umunna, JP Morgan Chase, of course, Global Head of Sustainable Solutions and EMEA Head of Green Economy. Now, switching focus to another part of the banking space, Bloomberg understands that Morgan Stanley is planning to cut around 2,000 employees later this month in the first major workforce reduction under CEO Ted Pick. Sources say the plan was set in motion before the recent market turmoil. Let's bring in Bloomberg Intelligence senior analyst Matt Ingram. Matt, what are the details around the Morgan Stanley job cuts then? 2,000 in the broader context of what, 80,000 employees?
Yeah, g'day, Tom. So yeah, you're right. It seems like a drop in the ocean from 80,000. It's not coming from wealth management at all. It's coming from the rest of the business. The explanation from management is, look, we were expecting a big ramp up in deals after the election in November in the US. Those deals haven't come, so they're investing more in senior headcount in order to generate that activity and generate that deals. We've heard from Goldman Sachs and others as well that the turnover of employees in the industry generally is very low. So Goldman moved forward their employee turnover plans this year as well, and we might see more of that from their competitors. There's just not the chopping and changing of employees that we're used to seeing. Morgan Stanley needs to clear some dead wood to make space for those business growers.
And we're also hearing about bonuses being trimmed. I mean, we're talking about restructuring, at least transformation, and this is when it comes to Citi and executives there maybe taking a hit to bonuses. What are the kind of the broader implications on the takeaway from a squeezed bonus pool for some of those execs at Citi?
It's a big one, Tom, not just for Citi, but for the industry. When you look at the likes of HSBC, that's been involved in transformation for a decade and a half, for Citi to tie the success of a transformation program so closely with executive bonuses might be sending shudders around the boardrooms of Wall Street. Citi's in a lot of trouble with the regulators. They've said they're going to fix their problems. They're not moving fast enough. And in the third year of the program, these execs are copying it. So what do we see from here? Well, I guess we'll see an expedition of the programs that they need to complete. But yeah, it's a big one for the industry. I think that this has been hit the way it has.
OK, Matt, appreciate your time. The update in terms of what is happening in the banking space with some job cuts, of course, and some reduced bonuses, for some at least, at Citi. Bloomberg Intelligence senior analyst Matt Ingram. Now to Turkey, where the mayor of Istanbul, Ekrem İmamoğlu, has been detained at his home by Turkish authorities. It's a move that could bar one of the country's most prominent opposition figures from challenging Recep Tayyip Erdogan in the next presidential elections. Check in on Turkey's stock futures under pressure right now on the news, currently down close to 4%. For more, let's bring in Bloomberg's Istanbul Deputy Bureau Chief Beryl Akman. Beryl, what does this detention mean? What's the significance and the implications then?
So since İmamoğlu was elected mayor first in 2019 and again last year, he has faced a slew of investigations and court cases, which he has said are politically motivated, and has held President Erdogan responsible, saying he's using the judiciary to have him barred from competing in the elections that are scheduled for 2028. But his detention today is absolutely an escalation in the developments. And like you mentioned, markets are reacting quite sourly in preliminary trading at least. It is unclear for now whether the opposition is going to move ahead with another candidate. İmamoğlu was supposed to be formally picked in the primaries that were slated for Sunday, and he was due to hold a rally in Istanbul on Saturday. However, the officials have ruled that there will be no rallies or protests in the coming 4 days, and some roads have been closed. So the environment and the climate is quite tense.
OK, a tense environment, of course, domestically, and we continue to watch the political fallout of this domestically for Turkey. Meanwhile, in terms of Turkey's international ties, leadership there looking for a meeting with President Trump, possibly next month. What are we expecting to see on that front?
So based on Turkish officials and based on Turkish statements that have come out so far, on the agenda of President Erdogan are two things. One is urging President Trump to lift defense sanctions that were implemented in his first term over Turkey's procurement of Russian S-400 missiles. The other is U.S. cooperation with Syrian Kurdish forces, which Turkey sees as an extension of the outlawed PKK group and is described as a terrorist is designated as a terrorist organization, which Turkey sees as a national security concern and threat. But we have yet to see statements from either of the two sides. But Turkey and U.S. relations have been quite volatile under Trump's first term and over the last few years. And it'll be interesting to see how perhaps visit in person plays out, especially with U.S. retreating from its security commitments in Europe, while Turkey and the EU are deepening their cooperation on that front.
OK, Bloomberg's Istanbul Deputy Bureau Chief Beryl Akman, thank you very much indeed on a significant day, of course, for the politics of Turkey. Thank you. Coming up, we're going to bring you the latest from Governor Ueda's press conference. He's speaking right now, of course, of the BOJ. Standing pat, but his lines, of course, on the external risks in focus as the yen softens. We bring you the latest lines and the context. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's give you the latest lines now from the BOJ Governor Ueda after the Central Bank of Japan held rates, but more interestingly are the lines, that was as expected, around external uncertainties. Ueda saying, for example, that in terms of external tensions, uncertainties over tariffs remain. They feel the pace of US tariff policy is speeding up. There are high uncertainties over US policy. A lot of his comments seem to be directed on the uncertainty around US policy. The Japanese yen is softer again in the session, currently at 149, down 0.3%. Let's bring in Bloomberg's Valerie Teitel, our markets reporter, who's been reading in and listening in, of course, to Governor Ueda and watching the market moves around this. There is this big focus on the external challenges. What kind of stands out to you at this point, Val?
Well, he does seem to be quite cautious in his language so far in the press conference. And this mirrors, the major change to the statement, that really the only one change to the statement earlier this morning, saying, trade policies are a risk to their outlook. Otherwise, that statement earlier this morning was very much unchanged. And he seems to be harping on these high uncertainties around the U.S. In his Q&A, saying there are high uncertainties over U.S. policy. Overseas uncertainties are rising. Recently rising quickly. So again, it seems like a note of caution from the Bank of Japan governor. He does not seem to be laying the groundwork for additional withdrawal of stimulus. And that's kind of the guide that the market is taking right now. We're seeing the yen weaken. It did cross the 150 line for the first time in 2 weeks. We're back down off of that, but the yen is still weaker on the session. We've been hearing that wage negotiations are suggesting higher wages. Inflation has been broadly moving higher on a number of metrics, and yet the governor is saying that the inflation trend is still below target. So if you pair that together with his comments on the challenging external environment and the policy risk from the Trump administration, where does that stand in terms of, where does that leave us in terms of our understanding of when they could go next? Well, look, the market was maybe expecting Ueda to lay some groundwork that there could be 2 hikes ahead. We thought maybe he could say some language that 1% is going to be the near-term target for the Bank of Japan, which would imply 2 more hikes for the remainder of this year, which is around what the market is pricing. But he seems not to be talking about hikes at all, instead focusing on the uncertainty ahead. He did talk about the wage increases. Remember the spring wage negotiations, which take part in early March had one of the biggest wage rises that we've seen in some time, over 5% for the last 2 years when it comes to wage increases. But he said that he saw those wage hikes as broadly in line with their outlook. So no upside surprise on wages, saying that they're broadly on track. Really, this is not a Bank of Japan who is preparing us for hikes ahead. Some had speculated that we could see a hike, as soon as, the April-May time. It doesn't seem like that's necessarily on the cards as they focus on caution ahead around the trade outlook.
Yeah, I'm saying that the bond buying plan can continue as well in terms of what they're saying on that front. A really unhelpful line from the governor right now, saying he will not comment on Trump's comments on the yen. So no comment on a comment on the yen. The yen, by the way, currently trading at 149.84, down 0.4%. If there are any additional important lines on this front from the governor, we will bring them to you, of course, but with the context and the market reaction. Valerie Teitel, our markets reporter. Valerie, thank you. No rush, it seems, to raise rates from here. Rates in Japan and the Bank of Japan are currently at 0.5%. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, and a word of warning from Bank of America around the run-up in stocks prices for Chinese equities, both in terms of the Hang Seng China Enterprises Index and the MSCI China Index, both up about 20% since the lows of mid-Jan. Bank of America saying this has similar feelings to 2015. You can see the run-up there. So go back to 2015, you see the run-up, and of course, the massive correction on the back of that took a long time for the MSCI China Index to repair and regain after that huge drop. Bank of America says maybe the markets are overlooking what's happening in terms of the jobs front in China, deflation, credit demand, but also, arguably, not pricing in investors in terms of that exposure to Chinese equities, the geopolitical risk as well. So a warning from Bank of America that you could see the kind of correction that we saw back in 2015, given the run-up that we've seen in Chinese stocks. That is a story to continue to monitor. Let's flip the board and have a look at the valuation question when it comes to US stocks versus their global peers. In terms of March and what we've seen in terms of the squeeze of that valuation, and this, of course, is the S&P 500 12-month forward price-to-earnings ratio versus the global index. You have seen that squeeze, one of the biggest that we've seen for a number of the years. Takes you back to the kind of examples we've seen during the pandemic and the global financial crisis. The question really is, will the earnings story of the rest of the world catch up and justify some of that valuation premium that is starting to come through? Valuation still above 5-10-year averages for the S&P 500. The Fed, of course, is in focus and will be analysing the prospects on the opening trade next. Stay with us. This is Bloomberg.